Today we are going to be looking at IAS 33, and IAS 33 talks about earnings per share EPS. Now in today's lesson we are going to be covering some areas that we've highlighted here, and from our notes the areas we've highlighted are, as you can all see it on the screen, the first is the objectives of IAS 33. The second point we are going to be covering is why we calculate EPS. The third one here is the scope of IAS 33. The fourth, meaning of words used in EPS calculations. We are going to be covering a bunch of words that are often used in IAS 33 EPS. Then the next would be EPS and PE. PE stands for price earning ratio formulas. We're going to be learning the formulas there. Then the types of EPS calculations, they are basically two, and we're going to be knowing more about them in this class. And finally, which has sub-points, are calculations on, first is basic EPS, second is calculations on EPS when preference share is a liability, and we have calculation on EPS when preference share is an equity instrument. Then the fourth is calculation on EPS when cumulative preference shares exist. Then final one we have here is treating changes in number of shares during the year and how EPS should be calculated then. Now the last point talks about when there is new issuance of shares, when there are new issuance of shares by the company quoted on the stock exchange. Now before we start today's class, we would have to note that EPS, which we'll take in the scope, covers only listed companies, and listed companies are companies that have their stocks traded on the stock market, whichever country's stock market. Nigerian Stock Exchange, we have that for the United States and whatever country we have there. So now we'll be going quickly into today's class, and the first here is the objectives of IAS 33. Now objectives of IAS 33, or the aims of IAS 33, what IAS 33 wants to achieve and what it aims to achieve is, the first is to calculate the EPS to determine how much profit for the year can be allocated to each equity share held by ordinary shareholders. The second is to present the EPS. Then finally here we have compare performance of public companies. Now to compare performance, there are two ways. Either you compare with past records of your own company or the company, or you compare records with the competitors, your competitors. And competitors are companies that operate in the same industry as you or similar industries, that their products can easily be interchanged rather. Now in short, we have to calculate the EPS, to present the EPS, and to compare performance. Those are the three objectives of IAS 33. Calculate, present. Obviously, after you calculate, you have to do something to it. You have to present it in a manner that is readable to those who need the information. Then finally you compare, CPC as a mnemonic there. We'll move to the next aim of this class, and it says we need to know about why we calculate EPS. Why do we calculate EPS? Now there's a note here, and it says EPS is often used by investors, and investors in this means shareholders, to value how much of their shares held in a company has been able to in turn generate earnings that could be attributed to them. Now, investors are interested in EPS calculation to know how much each share that they own has been able to generate profits, and the profit we are talking about here is earnings, and later we'll give definition of earnings or how to calculate earnings when you have profits. How much each shares, now going back to where we stopped, how much each share owned by an investor, that is the shareholder, has been able to generate earning. That's one share, how much each share generates for owning the share. That means if I, as a shareholder, buy shares or stocks in a company that is traded on the stock exchange, if I buy one share, how much that share that I bought will or has been able during the reported year to generate earnings or profits for me for owning the shares. Now, that is what EPS is meant for. That is why we calculate it, to know how much profit we get from each share invested in the company. Now, the word each share is there because it represents one share. So if you have 100 shares, you know how much you get from each times 100. That's the total profit or earnings you get from your shareholding. Now it continues by saying these shareholders are ordinary equity shareholders. Now the shareholders concerned here are ordinary equity shareholders, and the earning concerned here is profit that is attributable to ordinary equity shareholders and no other person. Ordinary equity shareholders are people that bear the bulk of the risk in the business, and the business here is the limited company that is traded on the stock market. Now, of course, we know that ordinary equity shareholders are the group of people that make decisions for the company, or they are the owners of the company. So it goes to say, furthermore, EPS is used to calculate the price earnings ratio. Now I completed it by saying price of shares in brackets divided by the earnings per share ratio. So from here we could see that the price earnings ratio is the price of shares divided by the earnings per share that we would calculate to get the ratio. Now, which could indicate if a company is overvalued by its share price in relation to what it earns, and vice versa. Now the vice versa here is if it is overvalued or if it is undervalued. Now, to bring it to layman's term here, what we are trying to say is that if the company is overvalued, the price of shares is high, very high, but the earnings it gets from a share is significantly low than what the price gives us a perception to be. What the price is, the earnings is significantly low compared to the price. Now we'll do the calculations later on in the second part of this, but we'll quickly move over to this because we have a long way to cover. It says, going on, it says EPS has been standardized to make comparison easier between companies, and it is one of the easier ways to compare returns on your investment even in different companies, to know which gives you more earnings per share. Now the earnings per share here is in inverted comma. Now, since EPS tells us how much each share can or has generated as profit to you, you could use it to compare with different companies to know which company should I invest in that gives me a higher return of profit on each share I have in that, on each share I am willing to buy. So if I have company A, company B, company C, and in the three different companies rather, A, B, C, we have different earnings per share for each. So we could know that okay, the higher earnings per share means that company generates more earnings on each share owned. So if I buy, rather than buy one share in company A and I get a lower EPS, I could buy one share in company B and get a higher EPS on it. So it's used for comparison between companies to know which to invest in. So we move over to the scope of IAS 33, and scope means what IAS 33 entails, what does it cover and what doesn't it. It says IAS 33 is strictly for companies quoted on the stock market. Now, companies which have share price and companies about to be quoted on the stock market. Now, IAS 33 is only concerned with quoted companies, as we've said before. Only concerned with quoted companies. Then it goes on to say when a company owns subsidiaries. Now, subsidiaries, as we already know before we should go into this lesson, subsidiaries are companies owned by parent companies that the percentage of ownership rather of the parent companies in the subsidiaries is greater than 51%. Now, 51% ownership of the shares of a company by another company indicates that the company that is owned is a subsidiary to the company that has over 51% of the shares. Now, it could be 51% and above, as we should know, 51% to whatever percent higher than that. While an associate has lower but significantly more than others, we would do that in treating consolidated statements, but right now here we are concerned with IAS 33. So it goes on to say, okay, we're done with that. It says the meaning of words used in EPS. Now we are proceeding and we would also move over to the calculations part. It says meaning of words. Now we have words here that are used in EPS calculation. The first one is earnings. As we said before, we would try to look at the definition of earnings. Now, earnings are profits available to equity shareholders. As we said before, it's EPS's only concern is with equity shareholders and no other person. Ordinary shareholders, right there, ordinary equity shareholders. That is the profit or loss after deducting preference dividend. Now, the profit or loss referred to here is the profit after tax in your income statement. Now, the profit after tax in your income statement after deducting preference dividend. So you have your profit there, you deduct your tax, then after that you deduct your preference dividend. Now the remaining, the balance of the money, the balance of the profits is what we call earnings, and this earnings is the amount that can be distributed to the ordinary equity shareholders if the money is not supposed to be reinvested in the company. Now we have here, and for consolidated statements, after deducting earnings attributable to minority interests or NCIs, and NCIs are non-controlling interests. Okay, now the earnings are on continuing operations. Now there are things to know here. Continuing operation, as we said before, that we are only concerned with ordinary equity shareholders. Now NCIs are not part, they are not even the company. As we said, 51% owned by parent company, so there's a balance, there's a remainder. The remaining percentage is what we call NCIs, or non-controlling interests. We less their earnings to them, then we get the earnings only to the ordinary equity shareholders. And we have the definition of shares here. It says shares are units of ownership interest in a corporation of financial assets that provides for an equal distribution in any profits, if any are declared, in form of dividends. The two main types of shares are common shares, as ordinary equity shares, and preference shares. So here a breakdown to layman term is: share is a unit of ownership. Share is a way of breaking down ownership equitably. How do I say it like that? So that when it is time for dividend distribution, okay, you have 100 shares and another investor or another friend of mine has 1,000 shares. Rather than guessing how profits should be distributed between both of you, shares have already broken them down. So if the total shares are 100 plus 1,000, your other friend has 1,000, you have 100, so the total is 1,100. So if you want to share it, I'll take 100 over 1,100, you take 1,000 over 1,100. So that's how it goes. Sharing of dividends is also a way of distributing ownership to people. The highest shareholder obviously gets the highest dividend payments yearly if dividends are paid. So you could research more on shares. So we'll move over to the next one: market price of shares. Now market price of a stock is the price that it sells for on the open market at any given point in time. Now the price changes often, so that's why there's at any given point in time here. It's the price you could see to buy the price you could see to buy shares. That's rather the price you could see to buy shares now. That is the current. So the now price of shares is the current market price of shares. And we move over to ordinary shareholders. It says that should be shareholders. Ordinary shares are shares in a company that are owned by people who have a right to vote. We've said right to vote before at the company's meeting, and to receive part of the company's profits after holders of preference shares has been paid. It made mention of deducting preference share dividends here as dividends to preference shares under earnings. So they have rights to the earnings of the company. Now the earnings is the profit after tax less dividends paid to preference shareholders. Then we have the basic EPS here. It says basic EPS tells investors how much of a firm's net income was allotted to each share of common stock. It is reported in a company's income statement. So the basic EPS is basically the normal EPS calculations we have. Then we move over to the diluted EPS. Diluted EPS is a calculation used to gauge the quality of a company's earnings per share if all convertible securities are exercised. Convertible securities are all outstanding convertible preference shares, and we have examples here: convertible debentures, stock options, and warrants. So the basic difference between basic EPS and diluted EPS is the convertible part in the diluted EPS. Now We'll also cover convertible area in this note, so we'll wait till then to know how to differentiate them. So we have EPS and PE ratio formulas. Now we'll be giving the formulas here. EPS formula is profit for the year attributable to ordinary shareholders only, that is the earnings, and earnings is profit after tax less dividends attributable to preference shareholders. Then we divide that by the number of ordinary shares in issue by the company, number of ordinary shares that the company has issued out. And how do we get profit for the year attributable to ordinary shareholders? We've said it before, profit after tax less dividend paid to preference shareholders. So then we have the price earning ratio formula here. It says current company's share price, current company's market price of shares that we've defined before, the price of the shares as at now divided by the earnings per share, that is EPS. So we have the types of EPS calculation here. Then the two, as I said before, basic and diluted. In this lesson we'll be taking care of the basic, then the next lesson will be taking care of the diluted EPS. And it says both type of calculations of EPS differ when there is a potential ordinary share. The potential ordinary share or convertible ordinary shares, as we said earlier, that is the main difference between the basic and the diluted EPS calculations. So potential ordinary shares are financial instruments or contracts that may entitle its holder to ordinary shares at some time in the future. Now it entitles whoever owns it to ordinary shares or to become an owner, to become part of the owners of the company at some time in the future. Convertible liabilities and equity instruments, as convertible liabilities and convertible equity instruments, comprise of convertible debentures. Obviously we know debenture is a loan. Now when given the opportunity of the loan holder to convert the value of his loans to shares, that becomes convertible debentures. We have convertible preference shares. Preference shareholders are given the opportunity to change their preference shares to become ordinary equity shares. Then it is a convertible equity instrument. So we have the share option, choice to purchase new ordinary shares sometimes in the future at already agreed price, are all part of potential ordinary shares or convertible ordinary shares. So we have basic EPS calculation, net profit or loss to ordinary shareholders for the period divided by the weighted average number of shares in issue during the period. So that's the formula, net profit or loss to ordinary shares for the period, shareholders rather, for the period. That is also equal to our earnings divided by the weighted average number of shares in issue during the period. That's the same calculation that we've given for EPS at the beginning. That's why basic EPS is like the same basic. It's basically what EPS is, the simple form of EPS when there is no convertible instrument there. So, and there is weighted average number of shares because during the year the shares could change, number of shares in issue, the company could issue new shares, so we'd have to get the weighted average for that. But when there is no change in shares, it remains the same there. And it says here, when there is a loss, invariably EPS will be negative. When there is a negative numerator as the loss rather than profit, EPS will be negative automatically. Set calculations of basic EPS. Now we'll be taking care of each one of these. When there's preference share classified as a liability, there's preference shares classified as an equity, there's cumulative preference share. There are changes in number of shares during the period. As we said, we'll learn how to calculate the weighted average number of shares. Then there is bonus issue of shares. There's rights issue of shares. So we'll be taking care of these 6 mentioned here. So we'll start by the definition of preference shares. What are preference shares? Preference shares must be classified as equity or liability in accordance with the rules in IAS 32 Financial Instruments Presentation. If a class of preference shares is classified as equity, any dividend relating to that share is recognized in equity. Any such dividend must be deducted from profit or loss from continuing operations as stated above. Now, if the preference share is classified as a liability in accordance with IAS 32 also, any dividend relating to that share is recognized as borrowing cost, liabilities, debts, and the debt should the dividend paid to them should be recognized as borrowing costs in the statement of profit or loss. Now, this is an expense here. Both are technically expenses, but the classifications differ. So it says already deducted from profit or loss from continuing operation and no further adjustments. Then we'll move over to example 1 quickly. It says basic EPS with preference shares as liabilities. The first we said here, basic EPS with preference shares as liability. Treating an example on that. And it says there's an example here. It says in the year ended 31st December year 1, entity G made profits after tax of 3.5 million or 3,500,000 3,500,000 naira, whatever currency you use, dollars, Canadian dollars, whatever currency you use. Of this, 3,300,000 was from continuing operations and 500,000 naira from discontinued operations. Now note that we are only caring about continued operations, not discontinued operations, in calculating EPS. So it says it paid ordinary dividend of 150,000 naira and preference dividend of 65,000 naira. The preference shares were correctly classified as liabilities in accordance with IAS 32. Entity G has had 1 million ordinary shares in issue throughout the year. Entity G's basic EPS for the year ended 31st December year 1 is calculated as follows. So now we have the basic EPS, which has the same formula as the regular EPS calculations: net profit or loss attributable to ordinary shareholders during the period divided by the weighted average number of shares in issue during the period. So what the numerator is earnings. How do we get earnings? Profit after tax here, they wrote it as 3.5 million. Out of these, 3 million was from continuing operations, 500,000 was from discontinued operations. So we're only concerned with the 3 million here. Ignore the 500,000. Then it already paid ordinary dividend. We don't need that because we are looking for the general figure attributed to equity, ordinary equity shareholders. So that's what they gained. They paid part, but in total they still get more. And preference dividend of 65,000. Now the problem here is we have to know what classification according to IAS 32 is preference dividend. From them they said it is a liability. Now the liability has already been deducted. Once it's a liability, it means it has already been deducted before the profit after tax, so there's no need deducting it again, or you'll be deducting it twice. So what we are only concerned with here is the 3 million. So we have 3 million divided by the number of shares, which is 1 million ordinary shares in issue throughout the year. So we have 3 naira profits per each share owned in entity G by an investor. So for each share, I get 3 naira as gain. For each share in entity G, I get 3 naira as gain. Then we move over to example 2 with basic EPS, but this time classified as an equity. Preference shares is classified as an equity. Remember, if it is classified as a liability, you don't need to deduct it after profit after tax because it had already been taken care of before the profit after tax. Now, in the year ended 31st December year 1, entity G made profit after tax of 3.5 million. Of this 3 million was from continued operation, 500,000 naira was from discontinued operations. It paid ordinary dividend of 150,000 naira and preference dividend of 65,000 naira. Now the preference shares were correctly classified as equity. Now this is the difference between example 1 rather and example 2. This is an equity while the former was a liability here. Here, but this is an equity here. It says the preference shares were correctly classified as equity in accordance with IAS 32. Same entity G had 1 million ordinary shares in issue throughout the year. Entity G's basic EPS for the year is calculated as follows. Now we have the same formula here: net profit or loss attributed to ordinary shareholders during a period divided by the weighted average number of shares in issue during the period. Now what we do is get the earnings. So we have 3 million. Since we're only concerned with continued operation, now it is an equity, so you'd preference shares here was classified as an equity, so you'd still deduct it. This time you deduct it from the continuing operations here now. So we have 3 million less 65,000 naira. So let me guess, we have 2,935,000, I think. Yes, 2,935,000. So we'll do 2,935,000 naira divided by 1 million ordinary shares. So we have 2.935, but here it was approximated to 2.94 naira per share. As for each share, the ordinary equity shareholder gets 2.935 as his gain or his profit from investing in the company. Now we move to the third one, cumulative preference shares. It said some preference shares are cumulative preference shares. This means that if a company fails to declare a preference dividend in the period, now this is what cumulative preference shares are about. If a company fails to declare a preference dividend in a period, the holders are entitled to receive the missed dividend sometime in the future. So now if the company fails to declare dividends to the cumulative preference shareholders, they have the right to receive the dividends in addition to their future dividend payments. In other words, their rights are to receive a dividend. Their right to receive a dividend accumulates when a dividend is not declared. If there are cumulative preference shares in issue, the dividend must be deducted from profit or loss from continuing operations, regardless of whether the dividend had been declared or not. So there's basically no difference here. It says deduct it whether the dividend is declared or not. If it's not declared, still deduct it. If it's declared, still deduct it. So we have the same example here. Hopefully there are some changes. It says this is an example of cumulative preference shares. Example 3, it says in the year ended 31st December year 1, entity G made profit after tax from continuing operations of 3.5 million. 350,000. Entity G has 1 million 10% preference share capital in issue. Now the 10% in front of the word preference shares represents the amount of dividends to be paid on the general preference share collected, that is 1 million. So it says what it means is that every year the company would pay 10% of 1 million naira to preference shareholders as dividend. So how do we get the dividend now? 10% of 1 million, which is 100,000 naira, is the dividend to be paid every year to preference shareholders. Now entity G had 1 million ordinary shares in issue throughout the year. The number of shares doesn't change here. Entity G's basic EPS for the year ended 31st December year 1 is calculated as follows. Same formula: net profit or loss attributable to ordinary shareholders during the period divided by the weighted average number of shares during the period. So now we have, as we said, you always deduct it. You always deduct cumulative preference shares. Always deduct it. So we have 3 million, rather 3.5 million, since the whole 3.5 million was from continuing operation and none was from discontinuing operation, so we take it like that. 3.5 million less 100,000 naira, and we have 3.4 million. Then we divide it by 1 million shares, which gives us 3.4 naira per share. That's for every share invested in entity G here. You get a profit of 3.4 naira that is entitled to you. And we move to changes in the number of shares during the period. Now when there are changes in the number of shares, what do we do? Before, the number of shares remains static, 1 million ordinary shares in most of the example or all of the examples listed above. So now what if the number of shares increase during the period? What do we do? How do we treat it? It says IS 33 gives guidance on how to incorporate changes in share capital during a period into the calculation of the weighted average of shares that must be used in EPS calculation. Now is how do we calculate the weighted average of shares? So there are different ways in which number of shares may change. We are looking at ways in which the number of shares can change. Issue of shares for full consideration, that's the full value, the full market price. The company puts it out and gives it out at full market price for investors to buy. Then the second way is for no consideration at all. Now this is like a gift, put gift in quotes, a free share, usually to existing shareholders. Now example of that with no consideration are bonus issues, share splits, reverse share splits, and the like. Bonus elements in other issues, rights issues as issue of shares but less than. So we'll know the difference between rights issues and the like as we go on. Example 4. Now how to calculate the weighted average number of shares. Recall in previous examples, weighted average number of shares is the denominator in the formula. So the numerator, which is net profit or loss attributable to ordinary shareholders, which is also the earnings, doesn't have any problem. It remains static throughout. Rather, the denominator changes if there are new issues of shares. So you move over. It says time apportionment to find weighted average. How do we get the denominator? It says on 1st January a company had 5 million ordinary shares in issue. Then 1st April is issued 1 million new shares. 1st July an extra 1 million shares came into existence. 1st November 500,000 more shares were issued. All issues were at full market price. So here we have full market price, and we are asked to get the weighted average of the shares. Now there's a table here, and it says 1st January to 31st March. Now We start from the first month of the year, which is 1st January to 31st March. That's 3 months. Now we didn't include April because at 1st April, that's the beginning of April, new shares were issued. So our number of shares was not 5 million again, rather it increased to 6 million. Now we are looking for the period when our number of shares was 5 million. So it started from January to March 31st, before 1st of April when new shares were issued. So for the period of that 3 months, our number of shares were 5 million according to this table and the question here. So we have the time factor here, 3 months divided by 12 months, that's 3 over 12 times 5 million. We have 1.25 million, 1250000. And from 1st April we had new shares, so our total number of shares from 1st April becomes 5 million old plus new. 5 million plus 1 million, that is 6 million naira. So now we are now looking for the period when we had 6 million ordinary shares. We started having 6 million ordinary shares from April, then to June, because by July 1 we had already issued new 1 million ordinary shares. So April to June, the same method we used to for January to March, we would also do April to June. So we have 3 months also. Now our total number of shares is 6 million. 3 over 12 times 6 million, we have 1.5 million. Then the same process goes on for July's issue. We add 6 million plus 1 million, 7 million. July to October, 4 months. Rather than picking November, we pick the month before November, that's October. Then 4 months, we calculate 4 over 12 on 7 million, the total figure. We get 2.333, or 2,333,333. Then we add the 500,000 new shares, we have a total of 7.5 million total number of shares to December 31st, which is the last day of the year. The remaining months left are 2 months, so we do the same process again. Note that the total number of months must add up to 12. We have 2 plus 4, the numerators, plus 3, 2 plus 4, 6, 6 plus 3, we have 9, 9 plus 3, we have 12 months. So it's complete there. And we find the total, we have 6,333,333 as our weighted average number of shares. So that would be our denominator here, while we do the earnings as the numerator. Then we'll quickly go over to bonus issue now. A bonus issue of shares. Now this was done at full value. Now we have bonus issue here. A bonus issue of shares, also called a scrip issue or capitalization issue, those are names for bonus issue, is an issue of new shares to existing shareholders in proportion, not to existing shareholders in proportion of their existing shareholding, then for no consideration. Existing shareholders, proportion, no consideration. In other words, new shares are issued free of charge to existing shareholders. And we have the formula here for bonus issue fraction. We have number of shares in holding after the bonus issue divided by number of shares in holding before the bonus issue. We have an example here on bonus issue. Now bonus issue is for free. The former wasn't for free, still had the same market price linked to it. They wrote all issues were at full market price. Now here they are giving it for free to existing shareholders. It says a company has 4 million number of shares in issue. It made a 1 for 4 bonus issue. This 1 for 4 means for every 4 share you own in our company, we will give you 1 share free of charge. So if you have 100 shares, you have 100 divided by 4, so you'll be getting 25 new shares free of charge for your 100 shares in our company. Then it says the bonus fraction is number of shares in holding after the bonus issue. So we have after over before. After the bonus over before the bonus issue. So we have 4 plus 1. The 4 shares you have, they give you extra 1 to make 5 over the before. So before you had 4 shares, so the bonus issue fraction is 5 over 4. Note that the numerator would be greater than the denominator because there is an extra given for free. And the number of shares after the bonus issue to the company will be 4 million times 5 over 4, that is 5 million. Could even get that easily by dividing 4 million by 4. You get 1 million, then add it to the 4 million itself to get 5 million. So we have example 6 on bonus issue now. Example 5 was to get how to know how to get the bonus fraction, which here is 5 over 4. Example 6 will be going into deeper calculations. So it says company C has a 31st December financial year end. So obviously the year starts from 1st January to them. On 1st January year 5, it has 4 million shares in issue. On 1st July year 5, it made a 1-for-4 bonus issue. The financial results for company C in year 4 and year 5 were as follows. Now we have, luckily they gave us the earnings here, not the profit after tax. That means they've taken care of all the stress for us there, and the stress I'm talking about is deducting the preference share dividends from the profit after tax to get the earnings here. Now they've done that for us and given us the earnings itself. Year 5 has earnings of 20 million naira. Year 4 has earnings of 20 million, the same earnings, and it says there were no shares issued in year 4. So the only area where we have shares issue is year 5 in this question. On 1st January year 5, we had 4 million. On 1st July year 5, we had an extra bonus issue. The basic EPS for year 4, where there was no issue, that means there was no change in shares, it remains the same calculation we've done before. Earnings over number of shares, that's earnings 20 million divided by 4 million number of shares. We have 5 naira profit for each share bought in that company. Then we'll move over to calculating year 5's own rather. It says could be calculated for year 5's financial statement as follows: by taking as number of shares for the current period and previous period the total number of shares after the bonus issue, the weighted average number of shares in the current year using the method explained earlier is calculated as. Now note what we only have problem here is how to calculate the weighted average number of shares, and that is the denominator. The earnings doesn't change here. It says the date. Now we have date 1st January to 30th June, the month before July here. As for that period, we had 4 million shares, as in the question here. Yes, so how many months is that? January, February, March, April, May, June. 6 months. We have 6 months, 6 over 12. Then for bonus issue, you multiply by the bonus factor rather. Then when you multiply it, you get your weighted average number of shares here. Remember the previous one we didn't multiply because it was issued at full price. Now we are multiplying it. So we have 4 million times half is also 6 over 12 times 5 over 4. We have 2.5 million number of shares as the weighted average at that point, and we have 1 million new from 1st July. So total we have 5 million And the remaining months, the remainder of the months, since we had only one issue, is July to December, so that's 6 months. We find half of 5 million, that is also 2.5 million, and you get the total 5 million. Then note that the bonus factor is for the periods immediately preceding the date of the issue. It was issued on 1st July. Then the factor is used on the period before. I keep saying fraction, but here it says factor. So we would move over, and we've completed that. We've completed what is on the table here. So we have a total of 5 million as the weighted average number of shares. Then we move over to another calculation, and it says rights issue. What is the difference between bonus issue and rights issue? Now we'll know the difference by the definition here, or by the notes here. It says a rights issue of shares is an issue of new shares for cash. Here it is for cash, not free of charge, where the new shares are offered initially to current shareholders. Now both are for current shareholders in proportion to the existing shareholdings. Now both are also in proportion to their existing shareholdings, but this is for cash, and also the cash is at a discount to the market price, or the current market price of the shares. It is the discount means it is at a lower price to the current market price of the shares. And it says the issue price of the new shares in a rights issue is always below the current market price for the shares already in issue. This means that they include a bonus element. That's the difference. The discounts given to us, instead of a 6 naira share, they sold it to us for 4 naira. We have a 2 naira discount, or 2 naira reduction for us, because we are shareholders, to buy the new shares. And it says the bonus elements which must be taken into account in the calculation of weighted average number of shares. Also note that any comparatives must be restated by multiplying them by the inverse of the rights issue bonus fraction. So here we have the rights issue bonus fraction. Then it says the rights issue bonus fraction is calculated as follows. How do we calculate it? Formula: rights issue bonus fraction, and it says actual common rights price divided by theoretical X right price. And we'll be knowing each one of these. What do they mean? The actual common rights price is the market price of the shares before the rights issue. Theoretical X right price is the price of the shares, is the price that the shares ought to be in theory after the rights issue. Now we have before and after. The before is plain, while the after is after, but in theory. Now we could also know that here before divided by after. Let's see what the former gave us before. The former here is after divided by before. Now we have before over after for right issue, after over before for bonus issue, to get their fraction. So, but in theory as the denominator here. So we'll be looking at what that theory is and how to calculate it in theory. We have example 7. Company E had 3.6 million shares, 3,600,000 shares in issue on 1st January year 2. Note the year, note the number of shares, note the amount per share. And it says it made a 1-for-4 rights issue. For every 4 shares you own, you'll be given 1 share at a discounted price. That is rights issue. while bonus issue is for free. On 1st June year 2, we have another date here at a price of 14 naira per share. So now they'll be giving us one share for 14 naira per share. After the rights issue, there will be one new share for every 4 shares previously in sale, as we said before. The share price just before, that is the actual right price, was 50 naira. So now the real price of the shares is 50 naira, but they decided to give us rather at 14 naira. So we have a 10 naira discount there. Total earnings in the financial year to 31st December year 2 were 25,125,000 naira, 25,125,000. Now they've given us earnings now, not profit after tax. So we're still safe here, we're still lucky. Same calculation, but it's easy. Profit after tax less dividend paid to preference shareholders will give us our earnings. And it says the reported EPS in year 1 was 6.4. Now we have year 1's EPS here. They've calculated it for us as 6.4. So we have year 2 left. It says EPS for the year 2, 31st December year 2, and adjusted for year 1 for comparative purposes are calculated as follows. Now the theoretical X right price, we already have the right price here as 50 naira. It's plain in the question. Now we are looking for the price in theory. How do we get that? 4 existing shares right price. We have 4 shares times 50 naira, that's the right price. We have 200 naira. Then 1 new share for 40 naira. So total 5 shares, 4 plus 1 rather, we have 5 for 240. So we buy 5 shares for 240 naira. So in actual sense, each share is 240 naira divided by 5, that's 48 naira per share. So this 48 naira is the theoretical X right price, what each share is in theory. Then we have the fraction here. It says actual right price divided by theoretical X right price. We have 50 naira divided by 40 naira. Obviously the naira signs go, so we have 50 over 48, rather 48. Then the weighted average number of shares, we have a table here. 1st January to 31st May. Let's see the question. 1st January, then on June, new shares were issued. So the month before June is May. 1st January to 31st May, we have 3.6 million shares, 3.6 million shares in the question here. Now we are calculating for year 2. Now 1st January to 31st May, January, February, March, April, May. We have 5 months. 5 divided by 12. Then we will multiply it by the right fraction here. 50 divided by 48. So we have 1,562,500 as the number of shares. 1562500. And also we had new shares. How did we get our 900,000? 3.6 million divided by 4. Remember it says 1 new share for every 4. 3.6 million divided by 4. Total number of shares we had previously divided by 4. Then we add it to get the new number of shares owned. So we issued 900,000 new shares, and at 1st June, when we did the 1 for 4 issue, we now have 4.5 million shares, 450,000, and the balance of the month is 7 divided by 12. Remember, we'll have a total number of months here as 12, 7 plus 5. Then we get the value, 2,625,000 number of shares, 2625000. we sum it up, then we get the weighted average number of shares. Don't forget that the earnings calculation doesn't change, and the right fraction is done for the period before it was issued. It's calculated for the period before it was issued. Now, most of the calculations were gotten from our ICANN study pack, and it's worthy we mention it here. So thanks for the class. We'll be having the part 2 later on.